Silent Shift, 2010, and the Modern Economic Paradox. The decade following the financial crisis was labeled a recovery, yet, for many, it felt like a regression. We explore why the economy grew on paper while life got harder in practice.
The rescue mission. By 2010, the global priority was stabilizing a system on the brink. Central banks intervened with a clear mandate: save the banks, slash interest rates to historic lows, and flood the market with liquidity. The goal: jumpstart growth, reduce unemployment, and rebuild the middle class. The theory was sound. The plan relied on traditional economic logic. Cheaper money should encourage businesses to borrow and expand, theoretically driving employment and strengthening the middle class. Result: on paper, the plan worked. The surface level recovery. GDP growth returned to positive territory. Inter. Regular unemployment rate steadily decreased to pre-crisis levels. Inter. Regular market confidence, financial systems stabilized. Inter. Regular. By standard metrics, the patient survived. Unemployment numbers dropped. GDP growth returned. Confidence in the financial markets was restored. The crisis appeared to be over. The unnoticed engine. While the official economy stabilized, a secondary process began. The cheap money intended to stimulate production didn't just stay in the real economy. Commenter. Liquidity fueled prices, not paychecks. The influx of cheap money rapidly inflated asset prices. Home values, stock markets, and financial investments began to rise at a pace that far outstripped the growth of wages or production. The Great Divergence. This split defined the decade. Income grew linearly, but the cost of buying into the economy grew exponentially. The illusion of wealth. Initially, this inflation felt positive. If you owned a home or stocks, you felt richer. This wealth effect masked the growing disparity, creating a temporary sense of prosperity that hid the unequal distribution of gains. Matenas. Stability felt so expensive. Official indicators signaled stability. Yet, daily life became increasingly expensive. This cognitive dissonance became the defining mood of the era. The economy wasn't bad, yet life was becoming objectively harder. The moving finish line. Salaries increased, but the threshold for home ownership moved faster. The traditional milestone of the middle class, buying a home, transitioned from a difficult goal to an impossibility for many, despite full employment. Employed but insecure. The fundamental breakage of the post-2010s: you could find a job, but you couldn't secure your future. The link between hard work and long-term stability had been severed by asset inflation. The construction of a new order. Üçü beziden, tüpezi yönde. Looking back, the 2010s were not just a period of recovery. They were the years a new economic hierarchy was silently constructed. One where asset ownership creates wealth faster than labor ever can.